Hi traders, this is Ryan Littlestone from Forex Analytics. I'm doing the week ahead video this week as Blake has earned himself a well-earned rest. He's taken a long holiday for the Independence Day holiday, so he's getting himself nice and sunburnt on the beach somewhere and drinking lots of drinks. So I hope he's enjoying the weekend. Now, I'm doing this show just before the England game on Saturday, hence why I'm wearing my England t-shirt. So if we have a bad result, I'm going to phone up Steve and get him to edit the shirt out and put something else on. But in the meantime, come on, England. Right, well, first we're going to kick off with an offer we've got going on at the moment for our trader funding program. As you can see on the screen there, we've got a very good special offer. Anyone who takes a trader funding program assessment in the month of July will get a one-on-one 45-minute session with the man himself, Blake Morrow. He's going to take you through how he goes through the trading funding program, the sort of things he uses, how to approach the program if you haven't done one of these before. He's going to answer any of the questions that you have about the program, as well as any general questions on trading as well. So you get that free 45-minute session with him. So take advantage of it. And as I say, that's available to anyone who takes a program during the month of July. So check that out. You'll find the links to the TFP down in the comments section just below the video here. So have a look at that and check that out. Right, well, let's start getting into things. And first thing I'm going to do is just have a look at what's coming up this week. We've obviously just had the big NFP week, loads of data out from the US and elsewhere. So markets are still going to be, sort of half trading that coming into the new week. But this week tends to be a bit of a quieter week anyway after the NFP week for data. So I've picked out the key items that certainly I'll be looking at and that the market will be looking at also. So to kick us off this weekend, Sunday and over the course of Monday, we've got the second round French elections. Now, this is really a big deal because the first round was, okay, we saw that switch to the right, the big push to the right by voters in France. Le Pen's party, RN party, just coming up a little short of what would translate into a majority into the second round. She was polling, only between 35 to 39% in opinion polls before the first round, came in at around 33% in the final vote. So the market's taken that as not getting a majority. Now, this second round vote is sort of the cruncher. It's going to either lead to a Le Pen majority and that big swing to the right, which will likely be quite market negative in the interim. I say in the interim because, as we've seen from a lot of these parties, they do tend to sort of water down their policies once they get into power. So that's one thing to look for if we get Le Pen majority. Now, we're getting some polling, opinion polls coming through this week, this prior week, regarding the amount of seats she's likely to get. The polling's anywhere in a sort of 205 to 250 region. Those have been the numbers that have been coming out. Now, for any party to take a majority, they need 289 seats in Parliament. So polling around that 200 to 250 mark is going to leave her short of a majority. What that means is we're going to see the potential for a hung Parliament, unless the other parties, Macron, this new left alliance, cobble together some sort of coalition that can put together enough seats to take a majority and, sort of bumble through with some form of government. I don't know what that's going to be like, but I can bet you it's not going to be good news for France anyway. So if Le Pen doesn't get a majority, we could see the euro having a little bit of a rally, a bit like we saw last week. But a hung Parliament really isn't good news. So maybe good news for some that she hasn't got majority. On the other side, though, a mess in French politics isn't going to be good news going forward. So I'll be a little bit careful, depending on what reaction we get in the euro to whatever we get from this French election. But anyway, that's coming through Sunday and Monday, and we'll look at the euro in a bit more detail shortly. Unfortunately, or fortunately, depends on your viewpoint. Now we've had the UK election all done and dusted, and the Labour Party cleaning up with a big majority. The Bank of England speakers are all having their muzzles taken off. They've been shackled during the campaign weeks. They're not allowed to have any public appearances, but now we're over the election. They're back on the docket. As you can see there, we've got 3 speakers. First on Monday, we've got Haskell speaking. Then we've got Peel and Elizabeth Mann speaking. Catherine Mann speaking on Wednesday. So we'll get to hear what these guys have got to say about the last Bank of England meeting in June, where they left rates unchanged. You remember that 7-2 vote to keep rates unchanged, but in the minutes and the statements, some of those who voted for a hold apparently were very close to voting for a cut. So we may get a little bit of insight into there in how close they were to voting for a cut, and what that means for the next Bank of England meeting, which is in August. That will be a projection meeting. They call it the Monetary Policy Report, but it's where they update all their forecasts. So it's going to be a big meeting, and we might get a little indication whether a cut is on the cards or not for that meeting. The central banks don't stop there. We've got double bubble from Fed's Powell this week. He does his usual semi-annual testimony to both houses. It's the Humphrey Hawkins thing that we get every year, every half year. So we get 2 of those now. Usually the market's looking for, monetary policy clues from Powell. Usually his testimony itself is a bit of a rinse and repeat of the last FOMC statement, where things are. There has been the odd time when he's slipped in a line that we haven't heard. If he feels a need to guide markets if they've been going too far one way or another, but otherwise he tends to keep the actual testimony pretty, off the hymn sheet from the last FOMC. So what happens is we will get the text or the lines from that sometime just before he kicks off those testimonies. Obviously, it's the same testimony for both days. So once we've heard the first one, we can probably forget the second one. Now, this one could be a little bit of a show because we're obviously bang in the middle of an election year. So we're going to probably get a lot of these politicians trying to put a bit of a party spin on their questions to Powell, maybe trying to tease him out. Is he going to cut rates? Is he not going to cut rates? Is he going to help the economy? So there's going to be a very, very heavy election influence in this, likely from the questioning from politicians to Powell. So just bear that in mind. And, he may give us some clues, he may not. But as I say, once you've watched the first one, usually the second one's a bit of a rinse and repeat. We do have a central bank meeting this week as well. We have the RBNZ looking for their monetary policy, likely to keep rates unchanged. There was a little bit of a hawkish tilt from them previously. They did see some better data, some hotter data. Just got a couple of RBNZ governors and speakers talking a little bit more hawkishly. Since then, the data has sort of gone the other way, so that hawkishness has sort of deflated a bit. So this one's likely to be important just to see, are they still in the same vein, really, or are they going to, be sitting on their hands, continue to sit on their hands moving forward? That's going to be key, obviously, for Kiwi pairs this week. The data really, as I said, not a lot of data from Europe and the rest of the world, but in the US on Thursday, we get the CPI numbers, and that's going to be pretty big. I know everybody talks about the PCE being the main numbers, but we very rarely get big variation in that data, and CPI is the first of the inflation data we get before the PCE. So this is going to be a big number yet again. There's no expectations out on the calendars just yet this early, so I can't tell you what's expected for this month. But obviously, we know what the market's going to do. If CPI is hotter, that's going to play into the higher for longer narrative from the Fed, when we'll likely see probably the dollar gaining some, yields rallying. If it's much lower, and if it's significantly lower, given the mood the market's in at the moment, where it's looking like it's a rally sell in the dollar, and any bit of bad news, soft news is getting hit in the dollar. If we get soft numbers from these CPI data, that's going to ramp up expectations for a Fed cut later this year. You know, maybe a couple of cuts to come, depending on the severity of that data. So that's the big numbers on Thursday. Then on Friday, we get a little bit of secondary inflation, US PPI coming in as well. That sometimes adds or subtracts from what we see in the CPI numbers, depending, again, if there's a big variation, but there can be a lot of volatility in the PPI data. And then to cap Friday, we get the first Michigan numbers, the flash Michigan numbers for July, and a bit of insight into what the consumer's up to and those all-important inflation expectations. So not a huge data week as mentioned, but we do have some key items, as you can see there. Certainly I'll be keeping an eye out for those and looking to trade them as well. All right, so I'm going to have a little look around some of the charts now. So going to kick off with the euro, because we've got this election risk coming from France. Now we've closed the week pretty much on the front foot. The NFP data that we got on Friday, some are saying it's bad. It depends on your perspective, really. Jobs came in at 206,000. That's not a problem at all. People have been talking about the big revision from last month coming down as well. But again, the numbers for last month still staying 200,000+. So, you know, there's no big noise or big tree shaking going on in those numbers. Unemployment rate, that rose, but the participation rate ticked up as well. So that sort of can add into that calculation too. So if the participation rate had come down and unemployment went up, that would have looked a bit more negative. Wages came down as expected, 3.9% as well. You know, none of this softness is anything that's falling off a cliff, and I think that's an important distinction to make with some of this US data, because the market, as I said, at the moment is looking a bit more bearish. It's looking to hit any softness in the data. But what I think we're seeing at the moment, and that's across many sectors, housing, the PMIs, whatever, we're seeing softness, but it's not cliff diving softness. It's soft landing softness. If it develops into something more, then obviously that's a different story. But you know, we get the zero hedges coming out and saying that every minor data point is the end of the world. So, you know, we try not to get caught up in the narrative with those guys, that sort of analysis. We keep an eye on the data. Yes, I'm definitely seeing some softness. A few of us are, but it's not nose diving softness. So we need to bear that in mind. So anyway, the Euros finished the week up in the 108s, up around 108.40s. It's still pretty slow going. You know, it's taken pretty much 2 weeks to do sort of 170 odd pips. So, you know, we're not going gangbusters here, and we're staying within these well-worn ranges. Now, as you can see from the chart there, I've got a sort of channel. It's not something I'm looking to trade. It's just to sort of highlight that, as you can see from the latter part of 2023 into 2024, we have been in a bit of a shallow downtrend. So whatever's gone on in between, and we've got plenty of noise, plenty of ranges to trade. If you look at the wider picture, as I say, we're just in this bit of a downtrend still. And unless we look to break that, I think this range trading is going to continue. Now, further soft data from the US is obviously going to see the euro rising, but what we need to see early on in the week, as mentioned, is the French elections, how that's going to impact the euro. So there could be a little bit of noise, a little bit of counter trading here in euro dollar. If we're seeing other dollar pairs weakening, cable going higher, Aussie dollar going higher, Kiwi dollar going higher, you get the picture. You could get a bit of divergence here with the euro if the market's not taking kindly to what happens over those French elections. So the euro could be a little bit messy. It could create a little bit of a false narrative here, because some in the market might decide to start selling it. Others are going to think, well, the dollar's weakening, so I don't know why euro dollar's going down, and they might start buying it. So for me, it's going to be a little bit messy. I think we need to see what happens with these French elections, what it means for the future, what it means for the government policy or whatever. If everything's tickety-boo and we're going to get a government that can actually pass laws and keep the country running, then that's going to be positive for the euro. But it's a real coin toss at the moment what's going to come out of France come Monday morning. So the euro is going to be a bit of a dodgy one to trade, I think, at least for the early part of next week. But charts are into this 108.30.70 zone that I've had on my chart for many years. This is a big old zone, and it's one of those areas when you get in it, we can waffle around a bit in it, but when we've been away from it for a while, for a few weeks, or a couple of months, that's when it tends to show up and have a say in things. So you can see previously we've had little sort of pokes above the 108.70 area. We haven't held them. We've come back time and time again. So it's really an area where if you see it break and you start to see the price finding support on the top, then that gives you a bit of a foundation to maybe go with longs and to see if we push higher. But up above, we run into the 109s, 109.60s, 40s. You know, we've got levels every sort of 20 pips. We've seen plenty of resistance coming into those areas and indeed up towards 110. So slowly it moves, this one. Doesn't go too far too fast. So for now, I'm sticking with the range trading, watching the ranges. You know where support is, likely to see support down at 107 and down at these sort of triple bottom here on the short term, 106.70s. Up top, we need to get above 108.70 and then see if we can take on the 109 level. So as I say, let the price action do the talking. If we get a break above this zone, if it starts to hold, if you want to go long, that will give you something to build on. You know, if we drop below that line, that's where you're wrong. And above 109.10, it will start to look like perhaps we're challenging this yearly downtrend that we're in at the moment. As I say, fairly shallow though. Now another pair that I want to look at, particularly for the French elections, and got a little bit of both going on here because obviously we've got these BOE speakers piping up again this week as well. So Euro Sterling, I'm short this one at the moment. I did have a little short at 84.61, just playing into the first part of the French elections. But as we know, we got that higher opening. I decided to keep it, add to it into this 85 level. Now, those of you in the chat room and been following us on the Flow Show or everywhere else on Face knows how long I've been trading this 85 level for over a year, nearly 2 years. I was trading longs off this level. Now, as you can see, the first test we've got up there to the 85, the break point, it's held. I did a little bit of short on there. Again, I'm playing the possibility of bad news coming out of France. And what that can mean also is that if we see some flows out of French assets on a political instability basis, then some in the market will look for where there is political stability, and a huge majority, as we've just seen in the UK, tends to reaffirm to people that there is political stability in the UK. That could get some of those flows out of France. So we'll see money coming into the pound. So I'll get to looking to get a bit of a double movement, negative on the euro side and a bit of positive on the pound side. Should see this one heading lower. Again, if we get those BOE speakers this week talking up cuts for August, that should also put a bit of pressure on the pound, at least versus this pair. Maybe not so much cable, but it should do versus this pair. If I get any move down to the low 84s, I'll be looking to take some profit off of these shorts. I'm not expecting this one to be busting down to 82s or going, any sort of volatile run lower or even higher. So I should have plenty of time to adjust to the price action as it may be and as it shows up. But I'm short on this one, and as I say, playing it off against the French elections and what that might mean for flows, and then the Bank of England. I will have a look at cable as well. This it's been really quiet. It's not often you get cable this quiet, and it has been pretty tight. Obviously, we've seen a bit of a rally over the last week or so. A lot of this is to do with the dollar. The second phase of this has got to do with the dollar, a bit of dollar weakness. But we've seen the pound, pretty much well bid, sort of end of April coming into May. You can see we've had that rally off sort of the 123 area down there. And the pullbacks just got under the 38.2 fib. So this trend that we've seen pretty much since May, is still on track. We've not turned that around, and that's why I like the use of the Fibonacci's, because it just tells you how you're doing with the trend. Yeah, we had a little pokey below, but you know, the low 126s have held as support, and we've managed to build a base and push on from there. We have closed the week above 128, which could be quite significant, because again, it's another one of these levels where we've stuck our nose above but haven't managed to hold on to it. So it's going to be important here if we open the week above this again on Monday, and we find a base there during the course of the morning, or Monday we see a couple of tests of 128 and it holds. That's going to give buyers encouragement to, you know, any latecomers to jump on board and give it a good old push up towards 129. 128 and a halves, prior high 128.60s, that's going to be the next resistance area. Above there, it's the big figure up towards 129, which we haven't been above all year, so that'll be another key move if we manage to break above there. Dips, main areas going to be down at 127, though we have found a bit of support after moving above this 127.40 area. So that's been a bit of a pivot level, a bit of a support and resistance level. So we had a little break and we've held it. So that's going to be the near support, and then down into this zone, this big figure zone down here, and then those levels again down in towards the low 126s. So decent ranges here to trade. For cable, for now, it is looking a bit more bullish than it has done. So that's what we'll keep an eye on with that one. Now, I spoke about the RBNZ, and yep, they're coming up, so makes sense to have a look at the Kiwi. Now, a lot of these dollar pairs are all looking pretty similar. That's almost you know, pretty much a mirror image of what we've seen with the cable. We've had a rally late April into May, topped out around the 62.15 area, had a bit of a pullback, got through the 38.2 fib, but not too far. Again, this is another one, I haven't drawn it, but it was, after we hit those highs, it was just in a little bit of a, you know, short-term downtrend. We've seen lower lows, lower highs. It's broken that over the last couple of days. Again, this is more from the dollar side rather than what's going on in New Zealand. So that's obviously, dollar's always going to be a bigger driver here. Back above some of these smaller levels, back above the 61, closing above the 61.30s area, which again has just been another one of these little sticky points when we've been around here. Then we've got 61.50, 55. Again, it's just been a little support and resistance area. We couldn't get back above it middle of June. So again, this is going to be another test for this pair. If we start hitting some of these levels, and they are fairly minor, if you can't get through those levels, that shows you that, you know, yes, something's looking a bit bullish. In this case, the Kiwi's looking a bit bullish, but not bullish that people want to take it too far. So price action for me is always king. I always like to know, you know, can you break this level? If you can't break this level, well, if you're trading it, what are you going to do if it can't break that level? If you're long Kiwi dollar here and you can't get through that 61.50, you know, that's going to tell you might be time to take a bit of profit off the table, because if it doesn't break, if it comes back down, you don't want to be sitting there 30, 40 pips later thinking, I wish I'd done that. I wish I'd taken some money off the table. So the slice and dice strategy, we talk about a lot in our chat room. Always, when I'm in the position pretty short term, I'm always looking at these sorts of levels just to take a bit of profit in case it doesn't keep going. Then you know you've at least put some in the bank. So Kiwi dollar, yeah, pretty similar to a lot of pairs at the moment versus the dollar. Same situation. Aussie Kiwi has been really interesting. Again, this is another one that I'm trading. We have this we call it the magnet. This blue line down at 108. Time after time after time, we move away from it and we come back to it. It's a pretty amazing line, really. We don't stray too far from it. Yes, we have big moves and some extensions, but we're always coming back to it. This is one of the things you get sometimes with crosses, and particularly crosses with close correlated countries, close-knit countries, that the currencies tend to be pretty stable. But anyway, for this one, I've been watching it on the downside, and now I'm watching it on the upside. We've had this upside break. My levels up here are up into this 110.20, up towards those highs, 110.50, and up towards 111. So I'm just playing this a little bit on the short side at the moment. Again, we've had a little bit of a switcheroo. When we had this move down to the 107s, that was on the back of that more hawkish RBA that I was talking about earlier. When that flipped, now we've got the RBA, or people talking about the market, talking about the RBA maybe being a bit more hawkish. They haven't yet taken rate hikes off the table. Pretty much every RBA meetings for the last, I think, 4 or 5 meetings, since they've stopped hiking, they always talk that they discussed hikes but decided to stay on hold was the best course of action. So they're not taking hikes off the table. We've seen hotter inflation data from Australia. We've seen better jobs data. So we're getting a few signs here that are going to trouble the RBA. And that's why now we're seeing the Aussie dollar just outperforming a bit more than the Kiwi dollar. And I'm just really trading shorts up into these levels. I'm going to run shorts up to this 111. Over 111, I'll be wrong. 111.30, I'll be wrong. But I think that the Aussie dollar is probably not going to run too far away from the Kiwi, irrespective of what the central bank do. I don't think the RBA is going to go on another hike cycle where they're going to be hiking 50, 75 basis points. Yeah, there's a risk we might get one, but they're in the same position as every other central bank. They would rather be bringing rates down than putting them up again. But we know from history the RBA has been a bit of a flip-flopper. They were one of the banks that suddenly went on pause, didn't think they would have to hike again, and then they went and hiked again. So you can never rule anything out with these bozos. But technically, I'm happy to play some shorts up into this 110 up to 111 zone. And again, if the RBNZ, maybe they might help me out if they're not as hawkish as some might think, or if they are a little bit dovish and indicate that cuts are on the table, then, this one might be heading higher. But if they are perhaps a little bit more hawkish, then they'll do me a bit of a favour, and we'll see this one dipping back a bit. Just looking at some of the commodities. Oil, lots going on in oil at the moment. Now, it's keeping well bid. And there's several reasons behind that. We've still got these ongoing tensions in Israel and the thing that's picking up between Hezbollah now and Israel, which sort of brings the Iranian proxies into it and has a bit of a danger of enlarging the conflict over there, shall we say, and that will be a bit more of something that will affect oil. We've also, unfortunately, we've got this big hurricane passing through the West Indies, Jamaica, and heading into sort of the left-hand side, shall we say, of America, Mexico, up towards that sort of area. So that's another thing that's keeping oil well bid. We're going to have to see how that turns out. These things don't often last, and obviously for the humanitarian aspect, I hope it doesn't last. I hope it calms down pretty quickly. But once that passes by, and depending on what else we get through other hurricanes, this one could be in for a bit of a pullback. There's also a lot of chatter, fundamental chatter, that it's US driving season. Obviously the holiday, the Independence Day holiday as well. Market saying the fundamentals are back in oil. I'm a little bit wary of those sort of seasonals these days. It's a completely different ball game to how it was 10, 15, 20 years ago now. But, price is going to do what the price is going to do. If we look at something like the ISM manufacturing data, and indeed manufacturing data around the globe, it's not looking all that hot still. So for me, there's no real demand side pressure for why oil prices should be higher. But the market's going to be the market, and it's going to go where it wants to go. And we do have a little bit of a level here up towards the high 84s, 85 buck mark. We are holding this break point at 82.50. Again, it's another one of these levels that's seen plenty of action, support and resistance. When it's got above, it's held. When it's got back below, it's held. So that's really your main support point. If we start breaking down under sort of 82.50, that might be telling us that this rally has done it all it needs to do, or all it can do, and then maybe we're going to be slipping back into the range. Gold's another one to keep an eye on. This one has been ranging pretty nicely, and now we're having a little mooch up towards the top of the range, up towards that 2400 level once again. The levels in here are pretty clear. We've obviously got this 2300 down the bottom. There has been extensions, 2280. We haven't managed to get down and hold below either 2300 or this 2280s area. So the key levels have held up below. We've got another sort of little interim level, moderate level, 2330s. We sort of mooched around it. We've had a break above it, hit the next level up towards this 2365.70 level. As you can see, we spent since Wednesday knocking our head against it before we got the break today. Again, that bad or softer US data doing the damage for this one. So maybe we're going to get a move up to this 24 level, and that will be a big test for me. We've had these moves above it. These first two moves were on Israel headlines when we first got the incident that happened in Israel and the subsequent response. So they're just sort of spikes, and you can see pretty quickly afterwards we held that 24 level before. Then this one, we tried to have another break. We tried holding it, and then we cracked out again, and we haven't been above since. So this 2400 level really, again, is a key level. I personally wouldn't chase longs up here, but if you get a break, similar type of move here, get a break, and you start to see the price holding. Let me just zoom that in a bit closer. Start to see the price holding it as support. That will give you some conviction to try longs if that's the way you want to take it. You will need to get above this 2450 high though, just to keep the momentum going. If we hit our head against there, then we're going to have a bit of a battleground 2450. So pretty simple levels to trade in this one. You don't need to be a hero anywhere in between. Just have some patience and wait for those levels to turn up. Right, going to have a look at just a quick look at the yields. Because when you're judging what the dollar's going to be doing, yields should always be on your charts. You should always have yields somewhere in your watch list, something you can just have a little flick over to and see what's happening there. Now, 2-year yields, we're staying pretty tight in the range. Every time we've had good data, every time we've had Powell coming out and dismissing further rate hikes, we've seen moves lower. But then the market was seeing better data, it was seeing better NFPs, other data holding up. So we were getting another rally in yields. We've had another dip this time. Obviously, again, NFP doing the damage. Not a huge move here. So wouldn't be expecting the dollar to move massively. Again, this is more an indicator that the bond market sees this softer NFP more as soft landing numbers than nosediving numbers. Really, the key level is down into this 420 area. As you can see, we've had a lot of traffic around there. And it's a bit of a gauge, obviously what the market thinks about the Fed's going to do interest rates. So if we're down at, 440s, 420s, that sort of area, then the market is getting a bit more dovish about the Fed and the FOMC. And that may be, rate cuts are coming closer. For now, this is a fairly small move on the back of the NFP. So not much really to take from that, but that CPI data is going to be an important number as well. For me, I would be looking to be a buyer of 2 years if I saw a rally in yields up towards 5%. That would mean the price was coming down because I think there's no way the Fed's going to be hiking again, not as the data's coming out as it is recently, seeing far more softer data personally. So I think any good news again is going to be a rally sell. So if yields jump here, then the price is going to drop. You'll see dip buys coming into bonds, rally sellers in the dollar. So yeah, just keep an eye on this one over the CPI data later on. Obviously, Powell speaking too. That could have an influence in yields. If he says something a bit dovish, then we're going to see these yields dropping and the dollar with it. 10-year yields, I look at 2s and 10s pretty much. 10 years, big level down at 420 here. I know Dale's been speaking about this often. Now, I'm going to give a little bit of caveat here. Okay, technical analysis on yields is very flaky. Okay, we don't trade yields, we trade price. So if you're going to be using technical analysis, I know I've got the moving averages on here, but that's just because they're on every chart. The reason I have lines on here is just to highlight where in yield terms, so what it means for yields. And obviously, if these yields are holding at a particular level, the price is holding at a particular level as well. So it can be one and the same, but I'm not one for putting fibs and any other technical indicators on yield charts. I just watch the yields and what that implication means for the dollar and for interest rates. So bit of a bigger mover here in 2 years. This 420 area is going to be a big one, because if we start cracking below that, that means the market is getting a bit more dovish over the Fed, and we're probably going to be seeing the dollar selling, picking up a bit of a head of steam. Again, Powell on Tuesday and Wednesday, and then CPI and PPI Thursday, Friday, going to be the big watch points for this. Obviously, in between, we may get a ton of central bank speakers from the Fed as well. Last one I want to look at is stocks. This one's keeps moving. The reason I'm looking at stocks at the moment is because we've seen another reaction, although it's held up at the top here in the last hours. We had another big reaction after the NFP. This is another situation where soft data has meant a rally in stocks. But I think we're going to be getting to the point where the data is going to matter for stocks, where bad data, bad jobs data, bad housing data, bad retail data, bad services data, if it is starting to snowball a little bit and we're heading towards rate cuts, I don't know how that's going to be good for stocks, because it's not going to be good for the economy. This has been a screwed up trade for since the GFC and the banking crisis, where cheap money was floating around and it all went to stocks. Well, money's got more expensive and it's still piling into stocks. So, as someone who's been trading as long as I have, it still doesn't make sense to me after all these years. So I think there will be a point where if the data really does start tumbling, then it's going to be hard to see how stocks are going to maintain those gains just on the central bank easing program. Irrespective of that, the price is going to do what the price is going to do. It doesn't matter what I say, what I think. What I will only do is trade the levels. And the levels were pretty clear. I was speaking about this one over the last couple of weeks. We had this break, had a high made at this 54, 48, 50 area. Then we had a break above it, and we've held it. So we had a little bit of a range where the market didn't really know what it wanted to do. It was banging off this 55.20, pinging down to this 54.5, back and forth. It was a real battleground. We've had the break. We had the break on Wednesday. It's moved up. We've made a new high. But as you can see, we just got a little bit of a protective support area here. So people who took the break here, 55.20s are just parking a few bids around 28.30s, 55.28.30s, just protecting that level. So any breakdown has to get through both these levels. So if we are going to get a move south, this is where it needs to get through first. Otherwise, we're likely to see some good support coming in there. So if you're not long, if you wanted to get long, you missed the boat, I'm not sure about chasing it higher up here. Give yourself a chance to maybe get a test of support, because you know that if you're wrong, if you take a long, say 55.20s, you could maybe have a stop just below 5,500, which, as we've seen, is another support, been a resistance area. Now it's a support area. So you don't have to put a lot of money on the table if you want to try and get it on the long bus. If you want to push it, lower trade, smaller trade, wider stop, you can push it down to this 54.5 level. That's the sort of trading I'll do. Again, we're in one of these situations where we've never traded up here. There's no historical price data prior to this. So what I tend to do, I'm not one for taking trend lines that go off into the future. I like my tech to have history behind it. I like to see the price action. You know, some of you may remember way back, I traded the break of the 48 level, you know, ages ago. And I'll put all these lines on it was all short term, just watching what the price action did. The same exercise needs to be done here. I've put these lines on up here because this is where the price action has showed there's levels to look at. The same things up here. Have we got a high? I don't know. If what you need to see is something like this, where we make a high, dip a little bit, make another high. That gives you a bit of conviction. Yes, we've got a top in play, be it short term, long term, or otherwise. So that gives you a level to trade shorts off of. Now, you look at this, it happened twice. Maybe you try to short up here, then we break. You don't need to be wrong by much. If that level breaks, you've got to think, given the history in this asset, when levels break, they keep going for a little bit. So now we have to do the same thing over here. Wait for a high to be made. Let some time pass between it. Maybe we get a move down to, as I said, 55.30s. Maybe we get a move back up to whatever high we've got, 55.60s. It holds again. That's when you need to think about shorting it, not just chasing the market. And I've seen a lot of people shorting this market on every rally just because it's rallied. Let the price action give you the levels. Let the charts do the work for you. Doesn't mean you're going to be right all the time, but it gives you your risk places. It tells you, right, if we break this level, I don't need to be long for much, because history has shown me when these levels break, they go and they go and they go, and then we have to wait again. So if you want to be shorting the crap out of this one, get some evidence and reasons why you should be shorting it. And that's price action showing you that we can't get through a level, be it a day, 2 days, a week, longer, or whatever. And then from that point, if you're getting into shorts, you need to get down through the support levels. If you don't get down through the support levels and you're short, then you take a bit off the table. Make sure you put some in a bank, maybe tighten your stops a bit. Trading is all about reducing your risk to zero first before you make money. Always my first rule of trading. Get your risk to zero, then worry about the profits. And that's the way I've approached stocks, because they've just been a one-way train pretty much. Right, that's it. I'm going to call it a session for today. That's your week ahead video, hopefully giving you some good information, what to look out for, what assets to look to trade, how things have been going. As per usual, if you want to join us in the Forex Analytics chat room, again, the link will be below the video here. You can come and join us. We've got the usual trial. You can take a 10-day trial for just $1. And if you want to progress after that, then you can have my special Forex Flow code, FFL20. That'll give you 20% off your subscription for as long as you subscribe. It's not just a 1 month discount. That'll be a discount all the way through while you keep subscribing, whether it's on an annual, monthly, semi-annual, whatever. So you can use that code FFL20 from me at Forex Flow. And on that note, I will wish you a great rest of your weekend. I look forward to seeing you next week if you're a subscriber in the chat room. If not, come and join us on the Flow Show every morning in UK hours if you're about then. Otherwise, I'll see you on Face, and next week we welcome Blake back as well. So he'll be back doing the show next week. Thank you very much, everybody. Have a great rest of your weekend.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.